An Introduction to Finance, Managing Funds and Assets Over Time. Introduction to Finance. Finance is the study of managing funds and assets over time. It has three main areas: financial institutions, financial markets, and financial management. The key drivers of finance are the time value of money and risk, as it deals with changing asset values and uncertainty about the future. Relationship between finance, economics, and accounting. Finance, economics, and accounting are different but related fields. Finance focuses on optimal asset allocation for future returns. Economics analyzes how people, businesses, and governments interact in the economy. Accounting communicates past financial information. Importance of finance. Finance is important in all business functions, the overall economy, and personal finances. It affects everyone and helps individuals make investment and financing decisions. Nearly all jobs require financial skills, as budget management and funding requests are common in business. Finance also involves analyzing and making decisions under uncertainty. In summary, finance is about managing money and assets over time, and it impacts business, the economy, and personal finances. Understanding finance is valuable for making wise decisions in various management positions in everyday life. Corporate finance. Corporate finance's main role is to figure out how to maximize the value for the shareholders of a business. This can be done over the short term and the long term, but sometimes these goals may seem conflicting. The finance department's task is to allocate assets wisely and manage the company's liabilities to ensure optimal financing for projects without taking on excessive risk. It involves deciding where to invest money and when to borrow funds to achieve the goal of growing the business while keeping shareholders happy. Financial managers. Financial managers play a crucial role in ensuring the financial well-being of a company through investment strategies and long-term financing decisions. They analyze data and advise senior managers on ways to maximize profits. The role of financial managers is evolving with technological advances that streamline financial reporting. Types of financial managers. There are various types of financial managers, including controllers, treasurers, credit managers, cash managers, risk managers, and insurance managers. These managers handle specific financial aspects like preparing reports, budgeting, investment planning, and risk management. They must possess analytical communication, math, and organizational skills to excel in their roles. Corporate finance helps businesses. Corporate finance plays a crucial role in helping businesses make smart financial decisions and effectively manage their resources. It involves budgeting and allocating assets across different business functions to achieve the best results. Corporate finance also determines how to fund projects, whether through internal funds, borrowing, or selling equity. The main goal is to maximize shareholder value. Simple examples of corporate finance in action could include budgeting. The finance department of a company analyzes the financial data to decide how much money should be allocated to various departments for their operations, such as marketing, research, and development. Valuing projects. Suppose a company has two potential projects to invest in, and the finance team evaluates each project's potential value based on factors like expected revenues, costs, and market conditions to decide which one is more promising. Financing decisions. When a company needs funds to expand or invest in new equipment, the finance department explores different options, like taking a loan or issuing stocks, to find the most cost-effective and suitable financing solution. Dividend payments. The finance department assesses whether the company should distribute profits to shareholders in the form of dividends or reinvest the earnings to support long-term growth. Balancing short-term and long-term goals. The finance team ensures that the company has enough liquidity to handle short-term financial obligations while still investing in long-term growth opportunities. Business ethics. Ethics are moral principles that guide how. Ethical principles are important in various management positions, including professions like managers, lawyers, and accountants, who have specific obligations to their clients or the public. Professional organizations and licensing authorities set and enforce ethical standards for these professionals. Business ethics, key terms. Ethics, moral principles guiding behavior. Values guiding principles in life, including personal conduct. Business ethics, application of ethical values to business practices. Professional ethics, ethical standards for individuals in specialized professions. Business scenario in a corporate setting. Decision-makers use ethical principles to guide their actions, promoting corporate social responsibility and eliminating unethical behaviors that may harm the economy, environment, or society. Personal values are beliefs that guide our behavior and decisions, and they are influenced by our upbringing, culture, and experiences. In the workplace, employees are more likely to make ethical choices that align with the company's values if their personal values match those of the organization. For example, if someone values equality for all, they may not feel comfortable working for a company that treats managers better than workers, leading to a negative attitude or even leaving the company. Investment decisions. The finance team has two crucial decisions to make. Investment and financing. Investment decisions involve allocating capital to assets that will yield the highest return for the company over time. The finance department must consider both short-term and long-term goals when deciding where to invest the company's money. They also evaluate the expected return on investments to ensure they align with the company's risk tolerance. Investment financing. Financing decisions, on the other hand, focus on how to pay for the company's expenses and investments. The finance team can choose to use the company's own funds or raise money from external sources like loans or selling equity, shares of the company. By making smart investment and financing choices, the finance team aims to maximize shareholder value, which is the ultimate goal for any business. Example: if a company values long-term growth and wants to invest into technology, the finance team will analyze potential investments to find the ones with the highest expected returns. They will then decide on the best financing method, which could involve using the company's retained earnings or issuing new shares to raise capital for the investment. By aligning these decisions with the company's values and goals, they can work towards maximizing shareholder value and ensuring the company's success. Recap: finance is a field that deals with managing money and making decisions about how to use it wisely. It is different from accounting, which focuses on organizing past financial information. Finance, on the other hand, looks towards the future and considers the time value of money, the idea that money today is more valuable than the same amount in the future. The course, An Introduction to Finance, teaches foundational principles and various aspects of finance, such as financial institutions, markets, and management. Finance is essential in business, the economy, and personal finances, as it helps individuals and companies make investment and financing decisions. Recap: financial managers. Financial managers are important figures in a business as they help make smart, money-related decisions and ensure the company's financial health. They analyze data, prepare financial reports, and plan for the company's long-term financial goals. Recap: ethics. Ethics play a vital role in finance and business. It involves knowing what is right and wrong and behaving ethically in all business practices. Companies that follow ethical principles practice corporate social responsibility, caring about doing what's right beyond just making money. Personal values and ethical decision-making. Personal values act as a compass, guiding individuals in making ethical decisions that align with their beliefs. When personal values match the company's values, it creates a positive work environment and promotes ethical decision-making, investment, and financing decisions. In business, two essential financial decisions are investment and financing. Investment involves spending money on things that make the company grow and earn more, while financing is about finding the best way to obtain money to pay for those investments and expenses. Both decisions aim to increase the company's value for its owners. The subspecialties of finance. Finance is the study of managing money and assets over time. It involves making decisions about how to use money wisely, invest it, and allocate it for various purposes. Subspecialties in finance include corporate finance. This focuses on making financial decisions within a company to maximize shareholder value. It involves managing assets, liabilities, and investments to achieve short-term and long-term goals. Investment management. This area deals with handling and investing funds on behalf of individuals or organizations to grow their wealth and achieve financial objectives. Financial markets. This specialty examines the buying and selling of financial assets, such as stocks and bonds, and how these markets impact the economy. Financial institutions. This involves the study of banks, insurance companies, and other financial organizations that provide services like loans, insurance, and investment products. The role of finance in management positions. Function of finance in various management roles within an organization. In an organization, finance plays a crucial role in various management positions. Financial managers help make decisions about how to use the company's money wisely. They analyze data, prepare financial reports, and provide advice to top-level management on how to achieve financial goals. They also manage budgets, assess investment opportunities, and ensure the company's financial health. The function of finance in business scenarios. Function of finance in various business scenarios. Finance is relevant to all aspects of business. It helps companies make decisions about investments, financing projects, and managing budgets. For example, when a company wants to expand its operations, finance helps assess the costs and potential returns of the expansion. It also determines the best way to finance the project, whether through borrowing, equity financing, or using the company's own funds. Financial principles. Identifying underlying financial principles that affect business decisions. There are essential financial principles that influence business decisions. One key principle is the time value of money, which states that money today is worth more than the same amount in the future. Finance considers this principle when evaluating investments and financing options. Another important principle is risk and return, where higher potential returns often come with higher risks. Financial managers weigh these factors to make informed decisions. Additionally, financial managers consider cost-benefit analysis, comparing the costs of a decision to the expected benefits to determine its viability. These underlying financial principles guide business decisions to optimize financial outcomes. Understanding finance, managing money and assets over time. Valuable for wise decisions in management positions in everyday life.